Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier, and I'm joined by my co host, Nugwa Haruna. We're doing things a little differently on this episode of the show. This time is all about you, the viewers. We want to tackle the burning questions that you may have about bonds. Some investors are turning their attention to fixed income with interest rates on the rise, but they might be familiar with how bonds work or how they fit into their investment plan. So, we're going to unpack some of the basics and try and answer any questions that you may have. We want to address as many as we can, so make sure to use the question and answer box to submit your questions. So within the platform today, up on the top right-hand corner of your screen, you should see the question and answer box. So go ahead and submit any questions you have around fixed income, and Nugo and I will try and tackle as many as we possibly can. There's also different video controls that are available for you to kind of take control of the screen and make things different sizes to whatever is your preference for the session. We've got some important links and registration links for upcoming live webinars and master classes, our YouTube channel. There's lots of great content on there. So just make sure that you click through and go ahead and take advantage of all of those different learning resources that are available. At the end of today's session, we'll also have a quick survey to get your input, to hear what you liked about the session or any feedback you might have. So stay tuned for that as well. All right, Nugwa, let's get our conversation rolling. Thank you so much for being here with me today.
I'm looking forward to our conversation. So, we're colleagues. So, and I know both of us have an idea of what fixed income is. So I'm looking forward to the questions coming in and us actually providing some great responses to any questions that we have during the session today.
Yeah, it's nice having you in the hot seat.
Yes,
All
yes.
right. So on that topic, you're one of the go-to instructors on our team for all things fixed income. So what do you find so interesting about this asset class?
So I think for me, it's the range when it comes to the fixed income asset class. So there's something for everyone. So if you think about it in terms of your risk level, for investors who have more of a low risk tolerance, there's something for them. It could be in form of things like a money market security. And those who maybe want to take on a little more risk, but still in the fixed income family, could consider some hybrid securities we have, which may give investors the opportunity for potential capital growth as well as some of that security that they crave. And then when it comes to things like liquidity as well, so for investors who want to have the ability to access their cash, there are things to consider. Once again, money market securities or money market funds. And then for those who want to be locked in to take advantage of whatever the rates are, there's also securities they could consider. So things like structured notes again, or even things like GICs. So that's why I love the fixed income family. There's so much to talk about.
Yeah, it's not like a one size fits all. There's so many different types of fixed income products within the class. Definitely agree with you on that one. So you teach a lot of our master classes about fixed income investments. So what are some of the common questions or concerns that you're hearing from our clients about bonds?
So I would say for right now, it's the fact that we know we're in a rising interest rate environment. So most very recently, we actually had more rate hikes, and now the overnight rate is at 5%. So the questions that we're seeing that are most prominent is, should I keep holding out for rates to keep going higher so it could take advantage of this? And so the first thing we always tell attendees in our classes are, you need to know what your goal is, as well as what your financial plan is. Now, if you already have a financial goal and a time frame, sitting out the markets or waiting and trying to predict the next move of the Bank of Canada may not necessarily work in your favor, especially since we're in a high inflation environment. So if you're sitting on a large bunch of cash, waiting for maybe more rate hikes, what could happen then is the value of that cash, it's being eroded. And at the same time, we might actually now run up to a rate cut as opposed to a rate hike. So these are things that investors keep asking, and we keep saying you want to know what your financial plan is and stick to that, because you might not be able to predict what's going to happen in the future.
Right, exactly. If only we could with any type of investing, if we could just predict what was going to happen in the future and be certain on it and be correct, we'd all be millionaires.
I know,
So,
I know,
um,
right?
So, on that note, let's go ahead and run through some of the bond basics before we start taking some questions. So, let's lay the groundwork for those who might be totally unfamiliar with bonds. So, what is a bond and how do they work at a high level?
Right. So when we talk about bonds themselves, typically these are issued by a government or corporation. So typically governments or corporations may have different financial operations. And when they're looking to fund these, especially corporations, they may sell a part of themselves. And that is where if you buy that, you invest in the company, you become a shareholder. On the other hand, there's the option for them to actually take out loans from investors or from the public. So when you think about a bond, if you buy a bond, you're essentially a creditor to these governments and corporations. So you want to think about it that way.
All right, perfect. Straight to the point. I love it. There's a lot of jargon that's associated with bonds. So, what are some of the key terms that an investor might want to know?
Right. So when it comes to bonds, this may seem a little dry, but we need to go over it so you have an understanding of how bonds work. So you'll hear the term bond issuer. Now, the bond issuer is actually that government or corporation who borrowed the money from investors. You'll also hear the term the bond holder. And so that would be you who's the creditor to that government or corporation. Now, one thing about bonds is they typically will have a time frame. So you may buy a 5-year bond, a 10-year bond, and so it means that these bonds will mature. So when you hear maturity date, that is when the principal amount will be returned. Now, moving on to principal. Now, the principal amount itself is the agreed upon payment that that issuer, government or corporation, will make back to the investor or the bond holder. And that principal is typically what we call the face value of the bond. You want to remember that because the face value of bond is very important when we talk about bonds. And so what tends to happen is if I buy a bond, let's say I bought a bond in the year 2020 and the bond matures in the year 2025. Well, what ends up happening is when that bond matures in 2025, I will be able to get my principal back. Along the way, because it is a loan though that I made to a government or corporation, they will pay me interest payments along the way. And so this is called the coupon. Those coupon payments are made semi-annually, but the amount is quoted as an annual amount. But what if I want to sell my bond and I don't want to wait until 2025? Well, I can actually sell my bond. Say I sell it this year in 2023. I will sell my bond at the market value. So the market value of the bond is whatever I receive for the bond when I sell it in between its issue and maturity. I might be able to sell that bond at the face value, or I might need to sell that bond for lower than the face value. If I sell the bond for less than the face value, we would say the bond is trading at a discount. If I'm able to sell that bond for more than the face value, we'll say the bond is trading at a premium. Now, finally, if I, as an investor, let's say, Caitlin, I sell the bond to you and you buy that bond, well, let's say you buy it at a discount. The coupon payments that were originally agreed upon will continue to be paid to you. But because you invested a different amount into this bond, your yield will be a determination or a percentage of how much you actually invested and how much you're getting back. So you want to think about a bond yield essentially as the return you get for the amount you invested in that bond if you hold the bond until maturity. I hope that's not too much information. And I do know we had a few of the terms on screen there, so you can always review that.
Absolutely. I'm going to put it all together. So, the investor, who is the bond holder, lends an amount of money, which is the principal, to a government or corporation, who is the bond issuer, for a set period of time, whatever the maturity is, in exchange for interest payments, which are also called coupons. The investor receives their principal back when the bond matures, along with the interest that they received in regular installments during the term.
Yes.
All right. So let's talk a little bit about some of the risks and some of the benefits of holding bonds. So what do those look like?
Right. So when we think about, as with any investment type, there's always benefits and risks. So we'll start off with talking about the reason why investors would even consider a bond. First would be capital preservation. So one of the things about bonds is, once again, you will receive your principal back at the end of the term of that bond. So for instance, if you put $100,000 in, you're expecting to get $100,000 at the end of that agreement. If you think about the reason why this is important, you don't necessarily get that when you're dealing with things like equities, right? Because in the case of equities, You may put $100,000 in right now, and you don't know if you're going to get that amount out in 5 years. Then another benefit of holding bonds then is that predictability. You're able to predict if it is a 5-year bond, I expect to receive my principal of this amount back. There's also the predictability of those coupon payments that you will get. So once again, you know the specific amount you will be receiving for that bond and when you'll be receiving it. So having that level of predictability makes a huge impact for investors who want to use this, for instance, as an income stream. The final benefit I want to talk about is diversification. So as an investor, within the bond family, we talked earlier about how there's something for everyone. So if you're looking for something that's less risky, you may still be able to get that in maybe government bonds. Something that's riskier, you may be able to get that in high yield bonds. And then also for an investor is maybe holding a different asset class like equities, they might be able to put some bonds in there as well to create diversification. So as with anything, holding bonds don't come without risk, right? So let's talk about some of the risks of actually holding bonds. So the first thing we want to think about is the benchmark interest rates. You'll remember that we keep saying that bonds will pay you coupon rates. And how are these rates created? Well, these rates are based off of whatever the prevailing rate is. So if I, as an investor, bought a bond 3 years ago when rates were lower and rates have gone up, well, the market value of my bond right now will not be so favorable compared to brand new bonds that will be issued at the current higher interest rates. So that's something an investor wants to be aware of, especially if you intend to sell your bond before it matures. You might not be able to receive that face value if interest rates have gone up. Another risk we want to talk about is inflation. Well, the thing with inflation is, as we know, when there's inflation, the Bank of Canada will increase rates to try and curb inflation, which then has that impact that I just talked about, which means interest rates going up, the value of existing bonds will go down. Something that is important to talk about is we keep saying the bonds will pay your coupon payment as well as your principal. Well, that will depend on the credibility of the issuer. Now, there are some bonds that, let's say it's a 10-year bond. When you purchase that bond, you believe you'll get all your payments. And then 5 years down the line, the company starts to struggle financially. They might not be able to make those payments to you. So you want to think about risks like that. Finally, I want to cover things like liquidity. So unlike the stock market, where pricing is more transparent, you don't necessarily get a lot of that when it comes to bonds. So they might be that trading liquidity there in terms of not having the same liquidity when it comes to the bid and the ask compared to stocks. I know that was a long one, but just keep in mind, and I'll summarize, the benefits will be capital preservation, the income predictability and diversification. And some of the risks then is the default, interest rate, the inflation, as well as liquidity.
All right. Yeah, it's a lot, but we got to look at both sides of the coin and kind of measure it out and figure out, to make sure we're covering all the bases. All right. So, one last question to cover before we get to our audience questions. So, what are some of the key factors that influence a bond's performance for investors to consider when they're researching?
All right. So when we think about the performance of a bond, Caitlin, we're mostly thinking in terms of the secondary market. So these will be bonds that have already been issued. And so we'll talk about that very important factor that I keep bringing up, which is the interest rates. So the benchmark interest rates, as we mentioned, investors always want to think about it this way. Interest rates and the prices of bonds are inversely related. So once rates go up, the value of existing bonds will go down. And so that's one thing you want to keep in mind. So if you have a bond portfolio of individual bonds, when rates go up, the value of your existing portfolio will go down and vice versa. So that's something that will impact the performance when it comes to bonds. Another important thing is the credit quality of the bond issuer. Now, typically bonds will be rated. There's credit rating agencies, just as individuals, we have credit ratings when you go to borrow. These governments and corporations also have credit ratings. And these ratings will range from like AAA all the way down to D. Now, bonds that are rated triple B or higher are typically called investment grade bonds. Anything rated below a triple B bond is considered a high yield or speculative bond. And so these bonds are typically tagged this way because the issuers may have trouble paying back the coupon payments or the principal amount. So investors want to be aware of the credit quality of their bonds, because what could happen then is when you go and sell that bond on the secondary market, you might have to sell it at a steep discount to get other people to buy that bond from you. Something else that will impact performance will also be things like inflation. So we talked about how inflation in the economy leads to increased interest rates, which in turn will lead to the value of existing bonds dropping. Finally, what I want to talk about would be the maturity or the time left on the bond. Now, I'm going to use an example in this instance just to make things more interesting. So let's say I have my bond I bought in 2020, and it's maturing in 2025. When I bought that bond, it was paying 2%. That was its annual coupon. Now, if rates have gone up, as we know, rates are higher right now. So brand new bonds been issued. Let's say they're paying a coupon of 5.6%. Well, if I try to go sell my 2% coupon bond, I would have to sell it at a discount in order for me to even exit the bond markets at all. But if my bond was maturing in a month, chances are I would not sell my bond at that much of a discount, because I know if I just held on for another month, I would get my full face value or principal back from the issuer. So what this tells you is the longer the term left on a bond to maturity, the more sensitive the market value of that bond is to changes in the interest rate. And the shorter the term left, the less sensitive a bond would be to any changes in interest rates. So these are things investors want to be aware of. These are some of the factors you want to consider.
All right. So we've gone through the basics and we've got that kind of all down. So let's go ahead and jump to some of our viewer questions. Let's see what our viewers actually would like to hear about today. So we have one question. So this question is coming in from Ryan. So how can I research the bonds available in WebBroker?
All right, so great question, Ryan. So WebBroker has a great tool where we have our fixed income platform. So instead of saying it, how about I show it? So I'm going to share my screen and pull up WebBroker. So give me a second. All right, so you should be able to see my screen right now. And so this is WebBroker, which is TD's trading platform. And so I'm going to show us how you can research bonds. Once in WebBroker, you want to click on research. When here, you're going to look under investments, and we're going to go fixed income. So I'm going to click on fixed income here. All right, so this is our fixed income page. I will mention that everything on this page is for the secondary market. So these are not brand new issue bonds. These are what we can safely call certified pre-owned bonds. So investors are able to see things like government bonds. We have government of Canada bonds. We have corporate bonds. We also have some provincial bonds. For that question, excuse me, I'm going to focus on agency bonds. So I'm going to click on 0 to 5 years. Sorry, give me a second. Okay, so I'm going to focus on 0 to 5 years. Now, once here, you can see the issuer. You can see the coupon, 2.9. This is based off of the face value of the bond. You also see when the bond matures. But what I want to focus on, if you're looking to buy a bond, you're going to be looking at the ask price. When it comes to bonds, the face value is 100. This bond right now is selling at 98.45, which means this bond is selling. Caitlin, do you want to tell us what this bond is selling at?
Yes. Sorry, which one?
So the ask price. So right now this bond is selling at 98.45. Would you say this bond is selling at a premium, at par, or at a discount?
It's at a discount because it's under 100.
Exactly. So because it's under the face value of 100, you would say this bond is selling at a discount. Now, if I purchase this bond, I will be paid 2.9% based on the face value. And for that reason, if I hold this bond till maturity, my yield will be 4.66, around 4.66%. So as an investor who's buying a bond on the secondary market, you really want to be looking at your ask price as well as ask yield, because this determines what you would get if you hold it till maturity. And then finally, you can see the credit rating. This bond is the highest rated. It's a triple A. So this is just one idea on how you can find bonds, and you can always filter through the different categories that we have here.
All right, very good. Okay. So that is our fixed income portal where we can find all those different types of fixed income products, or most of the products we talked about earlier on when we were kind of covering the reasons why you love fixed income. So there you go.
Yes.
Our next question is coming in from Raymond. So kind of an interesting one here. So Raymond's asking about a comparison between bonds, bond ETFs, and bond funds. So we're kind of looking at, the differences. So obviously bonds are a fixed income product. When we talk about bond ETFs and bond funds or mutual funds, those are different types. They trade differently, buy and sell them differently. So what can you tell us about the differences and similarities between them?
Right. Firstly, thanks for the break, Raymond. I was just choking on talking. So yeah. So to your question, Raymond, when it comes to comparing bonds, ETFs, and bond funds, essentially you want to think about it as a comparison of bonds and bond funds. Because when we say bond funds, we're including all kinds of investment funds. It could be bond ETFs or bond mutual funds. So to give you the differences between them, let's talk about individual bonds themselves, right? So if you're going in and you're buying a bond itself, you have the opportunity to buy a new issue bond. So for instance, I could go in, wait for bonds that are newly issued and purchase them directly from the issuer. And then I get to hold that if I want until maturity and receive my principal back. That's not the same case with your bond funds, right? Because your bond fund will be managed by a professional manager. And so what that looks like is the fund manager is the one that makes the determination as to when to purchase when to purchase bonds, when to sell them. They'll be the ones that determine if to hold bonds till maturity or not. Something else I will mention is, that thing of predictability we mentioned about bonds, how I can predict how much I get in terms of my coupon payments, and I can predict how much I get back in terms of my principal when my bond matures. Well, the
That
bond fund
security,
doesn't
right? That
necessarily, yes, yeah. So the bond fund
cash
doesn't
flow
have
preservation.
that because the bond fund manager will determine if to sell bonds in between, and those payments you receive may actually change when it comes to the distribution the fund is paying. So those are some considerations. On the other hand, though, let's talk about for investors who decide to use a bond fund, what the advantage there would be. The advantage there is if I don't have time to start researching individual bonds, well, I can just hold a bond fund because the fund manager has done all that work. So they have researched what they believe would be the best bonds if they're more actively, more of an active fund. And so in that case, you don't have to worry about the time in terms of doing that research. Also, when it comes to capital, if you're buying individual bonds, some of them require a minimum of $5,000 to get started. So by using a bond fund, you might be able to still use the same $5,000 and get a more diversified portfolio than you would if you just put $5,000 into an individual fund. The final thing I want to mention, though, is you want to remember, as long as you're using a fund, though, because these funds come with additional benefits that you don't get with individual bonds, you do want to remember, though, there is a management expense ratio. So there is a fee that the fund itself will charge because they're doing all that work. So just something to be aware of. And so some investors, they like the individual bonds, being able to see what exactly they're holding, and some investors just don't want to do the work and they want to take advantage of a professional.
For sure. And one other thing I'll just mention too, you were kind of talking about a barrier to buying a bond could be the cost, right? So a minimum purchase amount for a bond is often like $5,000, whereas with a bond fund, it could be $100, right? So with
Right.
immediate diversification. So there's an option too that if you don't have, a substantial enough portfolio that you want to buy a bunch of different bonds and diversify or ladder or however you want to build that portfolio, then a bond fund can give you that diversification with a lot less, in the way of money that you're putting forward. All
Right.
right.
Yeah.
Yeah. So we have a quick trivia question for the audience. It's a bit of an interesting one. So let's see if we can get it. Yeah, we've got it up on the screen here. So diversification is one of the main reasons why investors choose to hold bonds. How many years since 1977 have stocks represented by the S&P 500 index and bonds represented by the Bloomberg US Aggregate Bond Index both posted negative annual returns? So we talk about that, we went through the differences between stocks and bonds and how the idea is that they weigh each other out because one is, more stable, the other one's a bit more volatile. And hopefully when one's doing well, the other one, uh, if it's not doing well, sorry, the other one will be to kind of balance it out. So uh, how many years have they both been negative? So an interesting trivia question. We'll see what our audience has to say, and we will go ahead and reveal the answer a little bit later in today's session. So feel free to go ahead and choose what you think the answer would be. So A, B, C, or D. So never 2 years, 5 years, or 10 years. All right. We have another question, and this one is asking about something that we didn't cover when we were talking about research on WebBroker. Silva is asking, where on WebBroker do you buy new issue bonds? So Nugo, let's go ahead and navigate on WebBroker and show the audience where you can actually go and see some new issue fixed income products.
Right, great question. So yes, let's go back into WebBroker and we'll take a look because I had mentioned that what I was showing us, that portal was just for the secondary market for bonds. So I'm going to share my screen once again and we'll go back into WebBroker and we'll take a look. So just as a quick summary again, so when you're on the fixed income portal within WebBroker itself, these are, as I call them, certified pre-owned bonds. What you're going to find is chances are these bonds may be selling at a premium or a discount. You might be able to find some of them selling at par, but if you are looking to actually purchase a bond directly from the issuer, within WebBroker, you can see the inventory that TD Direct Investing carries. So in order to do that, once in WebBroker, you will click on trading. Under buy and sell, you will go new issues. So I'm just going to click on new issues here. So now, right now, you'd be able to see any current offerings we have. And just to add that the new issues tab is not just for bonds. It's also for different kinds of investments. So if there's newly issued stocks, you'll find them here, Canadian. You can see that we have some hybrid products, so things like structured notes, you're finding them here as well. So that's something to be aware of. Now, even though we do not have any new issued bonds available, I'll just walk you through what the process would be if we did have something. So there's something up here. You would be able to click directly on that product itself, see some more details about it. I'm going to click on this one, even though it is a structured note. And when you pull it up, something that is very important, especially when you're purchasing something that's newly issued, would be the prospectus. And I would encourage you that as you come back here to check for the different offerings we have, you always want to pull up your prospectus to actually see the stipulations of your bond. Because some bonds are what we call callable bonds. So, for instance, the issuer reserves the right to actually buy back your bond from you. And some investors may not know that when they look at just the name of the bond. So, that's why you want to read the prospectus before you go ahead and make that purchase. I'm just going to go back to the list there. If you decide after reading the prospectus you want to go ahead, you can select that security and you would click on where it says place expression of interest. I want to highlight that even though it just says expression of interest, please be aware that you want to think about that as you making that purchase. So it's not you saying, oh, I'm interested, and then a month later, when the security is available, you say, I want to back out. No, you want to make sure you have the funds available. When you place an expression of interest, the quantity you receive, though, will depend on demand. So let's say you put $50,000, you might end up getting $20,000 of the bond instead, but you will never get more than the $50,000. So finally, what I will mention about the new issues page, though, is let's say you can't find what you're looking for, you can always update your profile. And your profile, you can set a notification alert to receive notifications of when specific kinds of securities are available. So I'm going to go where it says update profile. And once you scroll here, you can put in your name, an email address. When you scroll down, you can actually set up to receive a notification whenever any of these specific securities or all of them are available. And then you can update your profile so that you always be aware when there's something newly issued within WebBroker.
All right. Excellent. Yeah, it's always good to know where those new issues are. And like you mentioned, it's not just for fixed income. So that's if you want to take part in IPOs or anything else like that on the equity side too. So perfect. What a great rundown. All right. Let's go back to our trivia question here. Let's see what our audience thinks the answer to this question is. Okay, so we've got 50% think that it's never, so that they've never both had negative annual returns. 30% think it's 2 years, and we've got 10% on both 5 and 10 years. So let's go ahead and give our audience the answer. Stocks and bonds have declined in the same calendar year just twice since 1977, according to statistics by Schwab Asset Management. I got tripped up on that word. The bond index has risen in 67% of the years since 1977, as it has climbed in years when stocks were down 22% of the time. So pretty amazing, really, only 2 years. Our audience was a little bit more confident that there was more of a consistent relationship there. But I mean, 2 years since 1977 is that's pretty phenomenal, really. You know, the diversification's doing its work there.
Yes, and that's where that power of diversification comes into play, right? Where yes, it's twice in since 1977, but besides those 2 years, every other time you didn't get the same reaction. Now, we're not saying that bonds and the stock market are perfectly negatively correlated, but it just shows you the power of diversification, as you mentioned, Caitlin.
Absolutely, for sure. All right. We've got another question. Sorry, I'm going to ask the question before I even bring it up. All right. We got a question from Jason. How does a guaranteed investment certificate or a GIC differ from other types of bonds? So we could kind of call that maybe other types of fixed income instead of bonds, since we wouldn't really classify a GIC as a bond. So I'll let you take it away from there.
Yes. So we wouldn't call a GIC, a guaranteed investment certificate, a bond. It is a type of fixed income security. So essentially what a GIC does is, you would purchase them. They're also termed, there's some similarities. So they're termed as well. So you would have a specific time when your GIC matures and you'll receive your principal back. That's why it's called guaranteed investment certificate. They also tend to pay interest. So a GIC will be also quoted annually, the interest amount you'd receive, similar to bonds. But where the difference comes into play is the issuer. That's one of the differences. So with bonds, you will have a variety of issuers. You will have governments, you will have corporations. On the other hand, when you think about GICs, these are typically issued by trust companies and financial companies. So the issuers of GICs are more limited than when you think about bonds themselves. But the most significant difference is the tradability of GICs versus bonds. We just talked about the secondary market for bonds, which means that when I buy a bond, I am not locked in. I can sell it. Doesn't guarantee I'll get the same amount I put in, but I'm still able to exit my bond position. That's not the same with GICs. GICs don't have a secondary market. So when I buy my GIC, I am to hold it until it matures. It doesn't mean I can't exit, but if I do so, I will do so at a penalty. So I'd be charged a penalty. Now, there are exceptions to that case there. There are GICs that are cashable GICs. So after maybe 30 days, you can cash them. But you want to be aware, because these are more liquid, they may not offer the same interest as locking yourself into termed GIC. So these are considerations that you want to keep in mind. One last thing, though, I also want to mention about GICs, the difference between GICs and bonds, though, is that GICs are covered by the Canadian Deposit Insurance Corporation, so CDIC. So investors who are holding GICs, if the trust company or financial company that issued the GIC is unable to return your funds to you, CDIC will cover up to $100,000 depending on the issuer and per institution. I would encourage us to go check out the CDIC website to learn more. That is not the case for bonds.
All right, good. Yeah, I think that was a really good review of kind of all the important stuff, and we've got a slide up there as well showing some of those specifics for GICs. All right. We have a question here, and this one is from Michael. So Michael's wondering, what are preferred shares and how do they work? So Michael has noticed that they have both an equity and fixed income aspect to them, and they're confused. So we talked a little bit, we alluded to some other kind of hybrid type of products, is what we like to call them, of course, within the fixed income kind of space. And this is one of those hybrid products that we love chatting about so much, that falls under this category. So Nugo, tell us a little bit more about these preferred shares and how they work.
Yes. So as you mentioned, preferred shares, you may consider them a hybrid product. So what preferred shares are is they are shares. So if you remember when we were talking about defining bonds, we said corporations have the option of either borrowing money by issuing bonds, or they could actually issue a part of themselves and essentially give investors an opportunity to own part of that corporation. So preferred shares are shares. So if you hold a preferred share, you're considered an owner of the company. So that's the similarity they have with common shares. Now, on the other hand, how are they related then to bonds? Well, as we mentioned with bonds, bonds tend to have a maturity date. Some preferred shares, not all, but some preferred shares also have redeemable dates. So that could be where some of that similarity comes into play, where you might actually have a preferred share that may have a maturity date as well, or it could be callable. Remember, we said corporations may reserve the right, they'll put that in the prospectus if they're going to make that bond callable. And preferred shares can actually be callable as well, where the issuer says, hey, I want to pay you back a par value that they determine. In Canada, it's typically $25. And they say, we want to buy back our preferred share for you. And that brings to mind another similarity, which is a par value. So for preferred shares, which are callable, they will be a par value set. And as we mentioned, bonds tend to have a par or face value as well. But the most important similarity here is the stream of income investors may get from preferred shares. Now, stocks themselves, common shares may pay dividends. Now, these dividends, though, are not guaranteed. The company is not obligated to pay you dividends. They can cancel their dividends at any point in time. While preferred shares also pay dividends, but there's also the security in the dividends they pay. Because if a company doesn't pay dividends to its preferred shareholders, they may be obligated to make up all the payments they owe to preferred shareholders before they can make any payments to their common shareholders. So in that case, investors holding preferred shares may actually have a more steady stream of income compared to common shareholders. And that's where that similarity with bonds come into play. I also want to mention preferred shares tend to also have credit ratings, just as with bonds, and you don't find these with stocks. But the final point that I will mention is if a company does go out of business or does go bankrupt, you will have things like bonds. They are some of the superior creditors, so they'll get their money back before any shareholders. But then preferred shares will typically, holders will typically come before common shareholders.
All right, that was definitely a good rundown there, and hopefully highlights for our audience a little bit more about what we mean about it being kind of that hybrid product with those kind of fixed regular dividends, but it still has a bit of the equity side of things as well. All right, let's quickly run down what's going on in the room to make sure that everyone is still aware of what we have available for you. So question and answer box, top right-hand corner of the screen. We have a listing of important links. We've got videos there. We've got, different content available for you. So please check that out. Take advantage of all the resources that we have available for you. We also have upcoming events, so please feel free to register for anything that you might be interested in. We host these webinars on a weekly basis, so we would love to have you here for one of our future events. And finally, we will again have a survey at the end of today's session. So make sure you're taking notes on this session today so that you can provide us with some feedback afterwards. We greatly appreciate it. And this is, like I said, a newer kind of version. So hopefully you guys are enjoying this this live Ask Me Anything type of format. So I know that I'm having a lot of fun. I hope you're having fun. I can tell, Nugo, look at the smile on your face. You're obviously having a great time as well. So. All right. Excellent. Okay, so I think that's all the housekeeping. So let's get back to questions. So this question is from Dennis. So very interesting. We mentioned this a little while ago. What is a bond ladder and why would I want to build one? So tell us about laddering.
Yes. So I actually had a session a couple of weeks ago about bond laddering. I would encourage us to check out, our videos as well as webinars if you really want to learn about a bond ladder. But I'll give you a concise version of bond ladder. So bond ladder essentially is an investor may decide to purchase bonds that have different maturity dates. So the idea, once again, would be, let's say I have a goal in the next 3 years, and I want to make sure that, along the way, I'm able to, maybe I'm able to make sure I'm meeting some of my needs along the way. You could decide to use a bond ladder. Investors would use ladders in different ways. So an investor who, for instance, is anticipating continuous rate hikes may decide to use more short-term ladders, right? So you may decide to buy a bond that's maturing in 8 weeks, one that's maturing in 12 weeks, one that's maturing in 16 weeks, so that as those come due, you are actually buying new bonds that are being issued at higher interest rates. So that could be one reason why when an investor is building a ladder, they will use short-term maturity dates. On the other hand, if you anticipate that rates are going to fall, investors may consider using more longer term bond maturity. So, for instance, if I think rates are going to start falling, I may then buy one bond that's maturing in a year, another one in 2 years, another one in 3 years. Then at least I'm able to take advantage of the higher rates we have right now, even as rates fall over that time period. So let's actually go into Webroker so I can show you how you can actually build one. I'll make it a short one. So I'm going to share my screen.
Just a couple rungs on this ladder, eh?
Yes, yes. We'll just have a ladder that has 3 rungs. I don't want to keep us here all day.
All right.
So, all right. So once in Webroker, I'm going to show you how to build a bond ladder. So there's actually already some pre-built ladders that you can use. And to find these, you will go research. Under investments, we're going to go fixed income. So once you're here, I will mention there are some ladders already built, and you can utilize these and edit them as you see fit. You can build yours as well, and when you build them, you'll find them here. I have one built as a 5-year ladder, but we'll create one from the ground up. Now, one of the things I want to do is I want to take into consideration diversification as I build this ladder. So I'll start off with Government of Canada bonds. I'm going to click on this one. Once I do this, I have some Government of Canada bonds here. I see the yield, ask yield is 4.5. So maybe I'm good with that. And I'm going to highlight that one. I see maturity is May next year. Now to add that to my ladder, I'm going to come up here where it says select portfolio name, click on the drop down, and I'm going to add a new portfolio. And I'm just going to call it 3 years. I'm going to add that. And then I'm going to add this specific bond to that ladder. So let's add a couple more. I'm going to go back home. This time, let's look at corporate bonds. And maybe I want to look at a corporate bond maturing in 2025, just so I have the next year. So I'm going to go somewhere here. So I see this Royal Bank bond here. I'm just going to select it. You do want to do some more research. I'm just building this really quickly in the interest of time. I see the the yield is over 5%. I'm going to scroll back up, click on my drop down, select my 3-year bond ladder, add to portfolio. Let's add one more. I'm going to go home. This time I'm going to choose municipal bonds here. I'm looking for a bond maturing in 2026. So let's say I go with this one from Metropolitan Toronto. I will select that. Go to my drop down, 3 years, add to portfolio. So now I have the 3 bonds. Now, the next thing you want to do is add the quantity. The quantity you want to add will be the face value of the bond, the amount you expect to receive back. So in this case, I'm just going to put 10,000 for each of them. It's going to take me a second here. Then I have 10,000 for each of them. So I expect to receive $30,000 back. A couple more things I want to add before we keep moving. I can see my maturity dates. I can also see the price that I'm paying. And then I can see the ratings of these bonds. But finally, I want to click Create Ladder Report. So once I click on that, just going to open this up. And now I'm able to look at my ladder. So this is giving me an idea. I haven't bought them yet, but now I can see that I will receive 30,000 back. But if I buy this, it's going to cost me just over $28,000. You're also able to see some additional information. This full portfolio with these three bonds, my yield to maturity, if I hold all of them, is around 4.7%. There's something else here mentioned duration, which tells you just how sensitive this portfolio is to interest rates. So if you remember, we said interest rates impact the performance of existing bonds. So this will tell you by how much the value of the market value of bond will change if rates keep changing. But finally, you will see what the total income annually you receive from these bonds are. There's one more page here that gives you a breakdown of your diversification or asset allocation. And then you can see what those payments will look like. Some investors want to make sure when they create their bond ladder, they're receiving a payment every month. So maybe if this doesn't work for you, you can go back and edit it, and then you'll see your credit ratings. So this is how you can build a bond ladder in WebBroker.
All right. Excellent. I hope that helped to highlight. I think that the bond ladder is definitely a great tool, and being able to sort of see it out in front of you and really see some of the details of it can be a huge benefit to those interested in kind of building a bond portfolio for sure.
Right.
All right. Wendy has a question for us, and this is a great one. So please review strip coupons bonds, which we usually would call strip bonds.
Yes.
So what are strip bonds? Tell us a little bit about that, Nugua.
Yeah, so strip bonds, they're also known as zero coupon bonds. So when you think about bonds, originally when bonds were issued, so this is old timey, when they were issued, they would have the coupons actually, the coupon payments actually as coupons attached to the bond itself. So that when the date came around, so when your semi-annual payment was due, you just tore off that specific coupon and you sent it off to the company. They sent you a check and you cashed it. Now, what happens with the strip bonds is essentially those coupons are removed from that bond, and that bond is sold separately. So it's sold without the coupon. Now, if you remember, the reason you're buying a bond and holding it till maturity, one of the reasons is not only do you get a principal, but you also receive interest payments along the way. So then what's the motivation for you to buy a bond that has no coupons? Well, the reason strip bonds are actually still a thing is because you can buy a strip bond, but it will sell at a discount. So it's not going to sell at the face value. So for instance, let's say the principal, which you're going to receive in 5 years, is 100,000. The strip bond may sell for 88,000 right now, and that would be the incentive for you to actually consider buying it. So what I want to do is let me actually go into WebBroker and show you where you can find strip bonds, because there are strip bonds available to be purchased within WebBroker. So I'm going to share my screen again. So, okay, so in WebBroker, we're going to go back to our fixed income page. And for those of us who may not remember, we first got here by going research, investments, and fixed income. This is the same page. Now, you see where it says strip residuals? These are the strip bonds. And these timeframes represent when these bonds are going to mature. So if we look at the 0 to 5 years, when I click here, you'll see that they are selling at a discount. Something unique you're going to notice is you don't see, I don't know if you noticed, anytime we come on this page, we always see a column that says coupon. You're going to notice it's not here. That's because they're stripped of their coupons, but you are able to purchase them. And when you buy them, you will buy them at a discount. And when you hold it till maturity, you will receive the principal back. I know another question we tend to get is, well, if I buy it at $88,000 and receive $100,000, then will that be taxed as capital gain? I don't want to go too much down the taxation line, but the answer is no. That will be taxed as interest. So just something to be aware of when you're dealing with strip bonds.
Right. The interest kind of accumulates to the value until you get to the end at your full amount. All right. Kind of like a GIC, but kind of not. All right. We have another question coming in. This one is from Karen. Karen is asking, I've purchased government bonds before, but I'm thinking of dabbling in corporate bonds now too. So what are some of the things I might want to consider? So we're talking Canadian government bonds. As you showed earlier when we had those, I think they were Canada Post, some agency bonds. They tend to be the higher credit rating. So kind of AAA or that sort of thing when we're talking about Canadian government bonds, other government bonds, not necessarily, but yeah. So then when we're talking about the corporate side of things, then what are the differences? What are things these types of investors need to look out for?
So, Caitlin, you said that perfectly. So, one of the things, especially, I'll emphasize it depends on the government, right? So, if we're speaking about the government of Canada bonds tend to be the highest rated bonds at present. You're not going to find that in all government bonds, right? So, this is something you want to be aware of. So, if you go buy another country's government bonds, they may not be as highly rated as the government of Canada, but I will stick to the example being in the Canadian environment. So one of the things you want to consider is the credit rating, as we mentioned, and we actually have it on screen as well. You want to take a look at the credit rating. Um, Once again, just because certain bonds are called non-investment grade does not mean investors don't use them. But this is where you'll find it's corporate bonds that will typically fall in this bucket. So anything below a triple B, so that's one thing you want to be aware of, because the lower the credit rating, the higher the potential for default when it comes to paying those coupon payments or returning the principal. So these are things that investors want to worry about either when the bond is first issued, or if you decide to sell the bond on the secondary market. That's something you want to be aware of. And I also will say that in terms of dabbling in corporate bonds, now, if you're just sticking to the government of Canada bonds, that's where the idea of diversification comes in. So, how well diversified can you be if you're only dealing with government of Canada bonds? So, some of the perks of diversification may come if you're considering using corporate bonds, where there's more of a variety, right? So, you have a variety of there's banks, there's utility companies, so more of a variety there when it comes to being able to diversify your portfolio. So these are some of the considerations.
For sure. And you kind of talked a little bit about the different investment grades there. It's risk and return, right? So the lower the credit rating, the higher the risk, but also the higher potential for return. But you just have to kind of weigh that out a little bit, right? And sometimes we call them high yield bonds when they get to those lower credit ratings. And again, you need to call and speak with someone in order to buy those types of bonds because they are, of a higher risk and they're not non-investment grade sort of idea. So yeah, excellent. Okay, I think we've covered everything there. Hopefully that works for you, Karen. You're comfortable with that. We've got another question here. This one is from Kat. So Kat says, I'm a long-term investor, so I don't really care when the stocks in my portfolio move up or down since I don't intend to sell them anyway. Would I be able to take the same approach with bonds?
So definitely would say when from our position, any information we give, we always give that disclaimer that we're unable to provide any financial advice. But if you think in general about holding bonds, if you remember a lot of the risks that we talked about and performance factors we talked about had a lot to do with already issued bonds and bonds that were trading in between maturity. So, as an investor, if you enjoy predictability, then holding bonds until they mature, that feature is what will attract you to bonds. So, for an investor who doesn't necessarily buy and sell out of positions, utilizing bonds may work because then you're holding it till it matures. And additionally, now you know how much you're getting back when that bond matures. But you want to be aware, just as with the risks of using stocks, if you decide to sell that bond before it matures, there is a chance for fluctuation. Um, so taking the approach of holding bonds till maturity may work. But something else, we can also talk about the risks then when it comes to bonds. We talked about that reinvestment risk, where when that bond matures, all newly issued bonds now may actually be have a much lower coupon rate. So now you're going to reinvest the amount that you just got back from your matured bond into a much lower coupon rate. So you want to consider the benefits of using the strategy as well as some of the risks that may come along with it.
Okay, excellent. We have a question here. This one is coming in from Raymond. So it's a question around the cost of buying a bond. So what is the brokerage fee for buying a government bond, for example, $5,000 worth? Now, this is kind of an interesting one because there is no commission fee. So when you buy stocks and ETFs, you pay that $9.99 kind of per transaction, per purchase and sale with those types of purchases. But then when it comes to bonds, there is no commission fee, and any kind of price that you're going to pay is sort of built into the pricing of the bond, right, Nugo? So when we look at the interest rate, or sorry, the coupon rate, that's the coupon rate you're going to get. You're not actually specifically seeing a fee, but basically it's built into the pricing. Would that be fair to say?
Right. So when you're looking at buying bonds within WebBroker, as we mentioned, the commission is already built into that ask price that you're looking at there. So there's no separate commission. So whatever price you see as you go into plug the principal amount, typically when you're looking to buy bonds, actually, let me do this. How about I go into WebBroker and show us as opposed to just saying it. In WebBroker, let's say I was going ahead and I wanted to purchase a bond. And let's say I would stick to Government of Canada bonds. I would click on the 0 to 5 years here. Let's say I settled on purchasing this first one here. I've seen an ask price of 98.57. I will select this and then I would go buy. So once I do this, I can select the account where I can make that purchase. But once again, so you'll see the price. So this is the ask price of the bond. You will see what the yield is at that price. You will see when the bond matures. You will also see the maturity date, sorry, the settlement date of the bond. It's T+2 business days. Now, you have one of two options when you're looking to purchase your bond. You can either enter the quantity, which is the face value you want to receive back when the bond matures, or you can enter how much you have to invest right now, and then it'll tell you how much in principal you'll get back. So just to make this easier, I'm going to enter a face value amount, and I'll stick with the $10,000. So I'm saying I want to receive $10,000 back when this bond matures. You want to hit recalculate. Once you do that, you will see how much you need to invest right over here. It includes the principal amount, how much you're paying based on this price, as well as what we call accrued interest. Accrued interest essentially is when you buy this bond and you buy it before the next coupon payment, you will receive all of that interest payment, but you do need to make a payment to whoever have been holding the bond before because they were also entitled to some of that payment. So you tend to pay that when you're buying that bond. This amount includes your commission. So there's no separate, when you're buying stocks, they'll have a separate $9.99. It's not separate. It's just included in the amounts there when you're buying the bond.
Yeah, so we don't know exactly. It's not like there's a dollar value. We could just basically any fees associated are built into that interest rate that you're like are factored in, and that interest rate that you're receiving is what you're actually receiving.
Right, correct.
Nuga, time flies when you're talking fixed income, apparently, because we are somehow at the end of 1 hour already of our Ask Me Anything. So it's time to, unfortunately, bring this all to a close. So I would like to thank you, Nuga, very much for being here, for chatting with me about fixed income. I know it's been a lot of fun for me. Hopefully it has been fun as well for you. A big thanks to our viewers as well for submitting so many great questions. I feel like we had some great conversation. I'm sure that you have many more questions that we couldn't get to today. So Nuga, where can we tell our viewers to go to get more information?
Right. So as we mentioned, we're instructors at TD Direct Investing. We have great master classes that we offer. We love the interactivity of our classes. So I'd encourage you to sign up for our master classes. We cover things from like the basics of bonds up to hybrid products. So if you want to learn more about things like structured notes or preferred shares or even fixed income funds, you can attend one of our master classes. We also have great webinars now. We have great conversations with industry experts coming and talking to us about things like bonds themselves, things like bond funds. I'd encourage you to check out our webinar list for any upcoming events, as well as any that we've had in the past. And I also want to mention we have great videos. You can find these as well in Webroker under our Learning Center, or you can find them also on YouTube. So a lot of resources we have available.
Absolutely. And as you just mentioned, we've highlighted on the screen as well those different links and resources that are available. YouTube, Learning Center. We've got a whole host of videos on fixed income, as well as the webinars, master classes, video lessons. We've got everything. So please join us. We absolutely love to have you there. So once again, thank you so much, Nugua. Thank you to everyone in our audience for participating, for asking the questions. It's really greatly appreciated. I will look forward to seeing hopefully all of you in a future session. Please take care. Bye, everyone.